Hello and welcome to Property Matters, supported by Fairview International Property Consultancy and auctionproperty.co.uk. And you can find this weekly property show live every Sunday on propertymatterstv.co.uk or by searching Property Matters on YouTube and Facebook. The show is also available as a podcast on our website, and it's also available to stream and download every Monday from 10 a.m. on any one of the 8 biggest podcast platforms listed in the search. No matter where you're enjoying the show live or on catch-up, we'd love you to get involved by adding your comments in the comments section below. And if you'd like to email us, we have an address. It is hello@propertymatterstv.co.uk. So let's welcome our guest this week. Joe Joshi is here, and also Bob Singh. Good morning, gentlemen.
Good morning,
Good
Paul.
morning.
Good morning, Bob.
Morning,
Nice,
Joe. Morning,
bright,
Paul.
nice, bright, sunny morning. So and full of news of money, which is why our man Bob is here. He's the money man, and I'll just talk property as I normally do.
Yes, this is the
Joe.
This is the news that, of course, this week the Bank of England did its largest rise in interest rates for quite some time. The base rate, of course, up 0.5% to 1.75%. It's the highest base rates rise since December 2008 during the financial crisis, and the largest increase, in fact, for 27 years. And I suppose the big questions that people will be asking, Bob, at this time are, right, is this the time to continue with my property purchase, or should I wait, or should I fix? There's so many questions. Just start off, is this the right time to buy now, because rates are starting to rise again?
Yes, it was the largest rise for many, many years since 2008. It wasn't that much of a surprise. I think it was the worst kept secret. I think the market was already factoring in a 0.5% increase. So, it's questions across the board, isn't it? Should I buy? Should I wait? Should I fix or not? So, but yeah, it's difficult times. It's confusing times for the first-time buyers because they're buying with a small deposit. If prices suddenly go into reverse, they could find themselves in negative equity. But I think the deciding factor will be your own circumstances. If you're having to move because of jobs or lack of space, or your landlord is saying please go, and you're wanting to buy, then you will have to buy. But you'll have to take a long-term view, a medium-term view, not a short-term view. You're not going to make money in the short term at the moment. Prices are still rising, largely, but I think the latest Halifax report did say slight dip in volumes, slight dip in prices as well for the first time. So if that trend continues, we'll see a more marked slowdown towards the end of the year.
A lot of people saying that actually this, as you said, it wasn't unexpected. And the fact that people are thinking, well, I'd better get on that gravy train right away because it's going to go only one way at the moment. So I better get in there quick and get on the ladder. And there's a suggestion that actually a lot of the lenders are going to be really, really busy over a time of the year, August, when most of their staff are away on holiday, especially those that are offering the most competitive rates. So there's a suggestion that actually the market's going to be even busier as a result of this, almost like panic buying, I guess. What do you think about that?
Yeah, we're seeing that already. People are clambering to get onto the fixed rates that are available right now because they see things worsening. Now, the inflation is expected to rise to 13%. And to control that, the rates are going to have to rise even further. I think even Rishi Sunak, when he was actually Chancellor, did say base rates could rise to 2.5% and 3%. And that's going to be a bit of a bloodbath for the mortgage market because that's, becomes really unaffordable according to current earnings. People's wages aren't going up. Inflation is quite high. In real terms, any savings are being eroded, really. So it's not looking good in the short term.
There's a suggestion that 5-year fixes really are not a good idea at this moment in time. There's a comment here from somebody on Mortgage Solutions this week. It says, at present, due to capacity, any lender left with the lowest rate is inundated with business, and with half of the staff on summer holidays, they can't afford to be the lowest rate in the market for long, so they have no choice but to price upwards, so that could be inflationary, and then the next lender at the lowest rate in the market moves, and so on. However, fast forward 12 months and you'll see levels dip, and then the banks, who still need to make a profit, will have to start competing with others again, and they'll want to win market share. So the suggestion here is that rates could be back at the level they are now in around 12 to 18 months, and then possibly lower after that. So be careful about locking into a high long-term fix and therefore buying at the top of the market. Do you think that's a fair statement, Bob?
It's a fair comment, but I think we also have to look at a bit wider than that because these things don't turn around quickly. It's a bit like an oil tanker in physical economics. So these changes are put into place slowly. It's not a 2% increase on day one. It's done in 0.25% steps. They see what the effect is and then decide to whether to, add a bit more. And this is what's happening. They're doing it stage by stage. They're seeing what those rate increases will have on the economy before they do anything further. And, the government is on a sticky wicket here because if they raise the rates too much, it really affects corporate earnings, their appetite for investment and recruitment, and increasing salaries. So you really got to be careful that you don't stifle the economy, that we don't go into a quick recession. And obviously, the forecast is we're going to have 5 quarters of recession. So this thing isn't going to end anytime soon. It will take us 18 months, 24 months to sort out. And yeah, you're right. 5-year fixes are expensive. Not because the banks are paying more to the Bank of England to borrow the money. They just don't want the business right now because they can't cope. The Coventry Building Society stopped taking applications, and 2 others also closed their doors. They said they just can't cope. Even after repricing upwards, applications are still coming in because there's that fear factor, FOMO. If I don't lock in now, am I going to pay more next year? And that's happening more to people who are coming off their fixed rates now. They don't want to be caught out and wait and pay more next year. They'd rather, even in some cases, pay the penalty now on the existing product and lock into a half sensible rate. But the old problem with mortgage brokers is they don't look at all the options when they actually advise a client. Typically, mortgage brokers will prefer 2-year deals, which we don't at Chess. We prefer 5-year deals, in fact. But now you've really got to be looking at 7 and 10-year products as well because they are still in the 2s and not in the 3s and 4s. So if you're really looking for long-term stability, I think now is the time to maybe consider even longer and go for a 7 or a 10-year product because the markets are telling us long-term rates aren't going to be staying this high forever.
Yes, if you look at swap rates, then 3, 5 and 10-year money is all lower than 2-year money, suggesting the market feels the rates will peak and start to come back down again.
Mm. Yeah, it's a question of when that will be, but I don't think it will be anytime soon. I think it will be a couple of years before we see that happening. And election time. And at the moment, as you know, the Bank of England is targeted to keep inflation at 2%, and we're expecting 13%. So it's going to be a fair while before 13 becomes 2 or 3%, and we return back to normality. And who knows, under the new government, the government may take control of the inflation target away from the Bank of England, which Gordon Brown obviously gave to them, some time ago. So, we shouldn't really mix politics with economics, but I think the governments do feel they've lost control with allowing the Bank of England to take these steps, and the feeling is the Bank of England have taken much longer than they ought to have done to start tackling inflation much earlier.
Joe, how did we ever cope with those heady days of inflationary pressure in 2006 and 7 when interest rates were 5.5% and fixes were about 7.5%? How do we cope?
Well, I think the reality of it is combination, the cocktail mix that I see now is probably a cocktail mix that we probably didn't plan for or didn't anticipate to a large extent. We all have always worked on mortgage rates, and whether it's the Bank of England or any successive government, they have yo-yoed mortgage rates in order to be able to control what they feel they can do with the property market to a large extent. But in comes a new mix, and that is the utilities, and that has something that we probably didn't bargain for. And this year alone, the amount of increase in your utilities, be it electric, gas, rates, and all the others that may well come along, every person has jumped on the bandwagon, including, if you take that as another set of blocks of bandwagon jumpers, every person has jumped on the strike bandwagon. So all of a sudden, they're all not getting paid enough, and so each person is now going on strike. And those are things that we haven't seen for decades, in all honesty. I can't remember the last time the strike mode was really used. Yet recently, we've had rail workers striking, medical people striking, and anybody else that feels that they get up in the morning and decide that they can strike and hold the government, the country, and the people to ransom in order to make sure that that works. So there's a new cocktail of mixes that has come into the program that we probably didn't actually bargain for, and that has increased the outgoings from all the people. So if you just sort of part the way with two things, in my opinion, and I'm not the financial advisor here, but Bob, I'm sure, will jump in on this, that you have got a huge amount of outgoings now that you never had with utilities. So in some cases, and I can only talk about on a personal basis, but that's a good enough barometer to work with, that your actual gas and electrics have gone up probably by 100, 150 pounds a month. Equivalently, the rates have gone up and so forth. So you're all of a sudden having to find another 200, 300, 400 pounds a month, probably just in utilities. And then now we add into that the increase in the rate. And that's probably the cocktail that is not a good cocktail that will actually, hold things back. Having said all of that, I think that obviously people will never ever stop buying. They'll always find a method, a way to buy a property. I've known that for 40 odd years, that no matter what happens, people will find a solution, whether it's through the lower amounts, or whether it's a different area they move to, or whether they have a fixed rate. They will find a route in order to buy, because one thing is for sure, and we see that even now, that house prices, even at this difficult time, has increased by 11% this year. And irrespective of that, it is still something that drives people to say, well, actually, one way or another, I want to own a home, because though I might pay more here, ultimately I will actually gain something in the long term. And that's where something like the fixed rates will help, because they can actually fix their outgoings, and say, right, we know that's our mortgage fixed for, at 2% or 1.5%, whatever the rates might be for the next 5 years. We know utilities. But one thing I think is that we're not going to see any of this have a reverse. The only reverse factor that's coming into it will be the Bank of England rate. And that's because there's this tug of war between the government and the Bank of England, in trying to deal with inflation, in trying to deal with the best method to put some brakes on the property market and all the others. But the utilities won't come back. There's no way under the sun that I can see. I mean, just look at petrol prices. There's another one, isn't it? Look at petrol prices. Petrol prices are not as high as they should be. But the petrol companies have sustained higher rates because they feel that they can. And so it is highly unlikely that they're going to have a reversal. They might do a 1 or 2 pence reversal here or there. But, a year or so ago, we were filling a tank with 100 quid. That a year later is now 200 quid. And so, and do they want to? I mean, if you've got people used to paying that £200 a tank, do you really think you're going to say, oh, well, I really feel bad for this guy, let me bring it down to £100? They might feel generous one morning and bring it down by 10p. And all of a sudden, that's the difference. So I think there's a whole new cocktail that we just didn't plan for, in my opinion. What do you think, Bob?
Yeah, I no longer open my bills because I don't fancy a heart attack with my breakfast, because it's just crazy, isn't it? And you can't lock it to a better rate because they're so high, and you don't want to lock yourself in. So it's very similar to mortgage rates, isn't it? You don't want to lock in and fear that you'll be stuck on the high rates. But yeah, no, it's if this period has taught us anything, it is to make us realize that we need to save for a rainy day, because those people who are unfortunately on the lower earnings bands will struggle because they don't have an option to save or invest, or have the right flexible mortgage which you can draw down upon when things are a little bit tight. So I think this has taught us that you need to take good advice on your finances, on your investments and planning, so that if there is a rainy day, you can ride the storm.
Let's put a scenario to you, Bob. You've got a young couple, first time buyers. They're going to look for a £250,000 property. They've got, let's just say, 5-10% deposit.
Yep.
And they're thinking they were all ready to buy, and suddenly this week the bombshell drops of a 0.5% increase in rates. Suddenly everything is changing, different situations, affordability comes into it. I mean, they may well have a mortgage offer in place, in which case they're probably going to be okay if they've already fixed, I guess. But let's just say they're looking for a mortgage product now. What advice would you give to a young couple in that position?
I think I would say, look, let's do your income expenditure again, and can you afford that mortgage? Because a mortgage isn't just about affording it for the first 2, 3, 5 years. It's a 25, 30, 35-year commitment. So I think they've got to make sure that their budgeting is spot on. Fixing is a good idea for first-time buyers because it disciplines them into sticking to a budget and managing within that budget, and eliminates the risk of any upward movement within your chosen fixed rate period. So I think, I think if the product is already booked, that means it's going to be lower than what you'd get today. But the downside is if you fail to complete on this particular purchase, that rate will be lost because banks don't renew offers once they've expired, and you'll have to apply for a new product from scratch, and that could be a lot higher. So I think if you're halfway there, I think stick with it. I think you've obviously bought that house or flat for a reason. You've obviously needed it. You've qualified for it. And given that criteria is tightening all the time, even though the affordability calculations are allegedly scrapped by the FCA, lenders are still being very cautious. So I think if you've got it, take it and carry on.
So would they fix on a 2, a 4, maybe longer? Would you suggest?
Um, it depends on the differentials. At the moment, there's not really any difference between a 2 and a 5-year product at all. So if they really want to be cautious, 5-year. But if they think that rates will drop in years 3, then a 2-year option might be a gamble.
And this is really not a time to be moving frequently, is it? I mean, this is a time to sort of get into the property and weather out the storm, isn't it?
I think so, yeah. I think the next 2 or 3 years are going to be a bit choppy. I think you've got to watch the markets, and if you're coming to the end of your fixed rates in the next 6-12 months, you might want to start planning now. Don't leave it till the last minute.
And apparently the market is pretty lively at the moment, Bob. They're saying that brokers are getting very little notice of repricing from lenders at any given moment at the moment because it's so volatile.
Yeah. The good lenders give 24 hours. Some don't give anything at all, and they just say, look, it's no longer available. So it makes our life difficult because we talk about what options there are, and then we pick one horse and run with it, and then we find out by the time we actually come to the application, it's not there anymore. So it's a bit disappointing for the client. It's upsetting for us as well because we have to start the whole process again. But yeah, it's not the first time we've been through this, so I guess we'll come out the other end and be okay with it.
Let's just move on the scenario a little bit. So you're coming to the end of your fix and you're suddenly looking at what you can afford. And of course, rates are so much more than they were 5 years ago or even 2 years ago. So what advice have you got for those people that are looking to refinance now?
I think get your mortgage offer out, get your document out and see what the early redemption charges are. Because the good lenders have what they call a step down early redemption charge, which means if you break the contract early on into your fixed rate, the penalties are high. However, if you leave it till the last minute, the penalty could be as low as 1%. So it could be that paying the 1% might be worth it, depending on your feelings about future rates. But if it's a level penalty, for example, if it's 5% for all the period of your fixed rate, then it probably isn't worthwhile ending your contract early. I think you've got to see it through the end. And the action plan should be that you should talk to your current lender or see what the current lender's offering is to keep your business, and then compare that with the open market, because sometimes the open market is a lot more competitive. You could make a saving by switching banks. And as mortgage offers are typically valid for 6 months, you could book a product with a competitor lender and see how it goes. Because if by that time your current lender is offering a better deal than the one you've booked elsewhere, you don't have to change lenders. You can stay with your current lender and change the products with them. That'll be a lot simpler and cleaner. Obviously, when you jump ship to a competitor, there's lots. It's fresh underwriting, new valuation, new income checks, etc. So there's a bit of a process to change lenders. But I think, yeah, just start planning early. 6 months is really the latest you should leave it from your fixed rate ending.
It's true, isn't it, Joe, that as long as buyers remain confident about obtaining a mortgage and being able to afford to pay it, interest rates are just unwelcome and an inconvenience, really. And it's suggested that this isn't really going to particularly slam the brakes on the economy in terms of house prices. And even with a half point rise, it's still comparatively cheap money at this time, isn't it? Looking at the graph that we've got, 2006-7, rates at 5.5% and now at 1.75. So it's still relatively cheap, but not what we're used to.
Yes, I think I think the rates and the demand for the property doesn't really deter it. What is actually deterring it is, like I said earlier on, is the unexpected stuff that is coming into that equation. So when Bob does his analysis for affordability, all of a sudden they are adding now quite a bit on the unexpected utilities that is now boosted up. So that means the actual amount that people have spare towards maybe a payment of a mortgage is now being reduced. So having said all of that, of course, 2%, 1.5%, 1.75% is still lower than what was there at 7%, which is quite a sharp, and it's even lower than what we at one time all experienced at 15 and 18% and so forth. So it's a far cry from there. But I think the problem we've had is this uncertain time that has been created partly because of pandemic. We kind of got over that, and then all of a sudden these governments started having a little infighting, and that's put the brakes on about who and where and what happens. And hopefully over the next month that will become a settlement, so we can start to sort of see what comes out at the end of the year. Because whilst there is that sort of uncertainty and each one of the candidates making all sorts of different promises, we're not really sure where that's going to land and how that's going to be. The only good thing about that, if there's anything that good can come out of it, it is at a seasonal holiday time. And right now, most people's priorities are to go and enjoy the sunshine outside, as opposed to worrying about whether they're going to buy their next home and what's going to happen. And from Bob's point of view, yes, there are some cases where people are coming out of old rates and now thinking, well, I should jump on. So he's certainly probably the busier of the lot, because there's that sort of balancing act that is happening where whether somebody comes out of an existing rate and fixes that now, and then of course lenders change their minds very quickly because they can't support the infrastructure to get those loans out. But from a property point of view, it's traditionally and notoriously a pretty slow time at this time of the year. And I think a lot of property wallahs, as I would say, are probably just sitting back and waiting to see what and who ends up in the chair for the Prime Minister's job, and how that will start to pan out. And that will then dictate which way a lot of people's train of thought will go as far as investment in property is concerned. But fortunately for property, for what it's worth, it's actually a holiday time. So it's during that holiday time that these little bun fights are happening, and just in time as the kids go back to school at the beginning of September, we should have in situ whoever that next person is going to be, that's going to help us steer the economy and of course our government and our thinking. And it's quite important to understand that. I mean, there's a lot of debate goes on. I get a lot of calls about who do you think it's going to be, why is it going to be that, is that right, is that wrong for the property market, should we do this now, should we do that then. When I look back at all of the times that we've worked in the property market, and Bob's done in the financial services, what hasn't really put people off in any of that journey is the wish and the want of owning their home. It's just a matter of how and when can I do that, and what will it take for me to actually get that. I remember doing mortgages back in the days, and nobody ever actually asked me what the rates were. I mean, they just wanted to say, where do I sign and when will I have it? It didn't really matter from that point of view. But we've become a little bit more, since with social media, like we're doing, we're becoming more and more aware of what the products are, aware of what the circumstances are, aware of things that are going on. And so we do take a little time to say, okay, is that right or is that wrong? But if you actually stop 10 people, in a street and ask them what their ideal wish and want is, they'll tell you that really one day I'd like to buy my own house. And how do I get there? I still get calls from would-be first-time buyers. It's sad to be said, but they'll call me uncle, which makes me feel a bit older. But they'll say, uncle, what do I have to do, and how do I get around to do this? And I always say, look, I know I look old, but please don't call me uncle. But they still carry on doing that. And as an uncle, we have to turn around and say to the first-time buyers, look, these are the steps and these are the things that you've got to do to try and get. But the point I'm trying to make is that there is still a hunger and that desire to ultimately have that own first step on the run of the ladder, and want to go there. So I think we're just hitting a time where there's a lot of uncertainty being created. And the sad thing about that uncertainty is it comes straight after the pandemic, which created a uncertainty in certain ways. But what it didn't do is put any stop on the property market. So I'm being now asked, is this a buyer's market as opposed to a seller's market coming up? In some cases, that may be the case. It depends on what's happening. As an auctioneer, obviously, I'm getting more and more people that are looking at an investment side of it, but are probably, giving a bit of an uppercut in where they might bid, as opposed to where they were bidding quite gracefully and say, I'll take that because I think it's a good thing. They're now coming in and saying, well, actually, I'll start there, and that probably there is 10,000-15,000 pounds less, only because they feel that they are in a position now to turn around and say, well, maybe I can get a bit of a bargain, as opposed to what I would have done maybe a year ago, when a year ago people were not even thinking about it. And most auctioneers are still achieving good sort of 50, 60, 70, 80% of sales on any given auction, which it clearly points out that the market is still resilient and very strong.
Indeed, it is. And just looking at some stats that have come in from Rightmove, with interest rates moving this week up by 0.5% to 1.75, as we know. So for the first time since 2012, the average monthly mortgage payment increases to an average of 40% of the gross salary. The average monthly mortgage payment for new first-time buyers goes over £1,000 for the first time per month. Average monthly mortgage payments for new first-time buyers are £976 per month pre 0.5% rise, so they're now 1,030. And a 10% deposit on an average first-time buyer's home now 22,494, which is 57% higher than 10 years ago. And the average asking price for the first-time buyer's home is a record of 224,943. And yet, despite that, monthly salaries have gone up 31%. So there's the dilemma for you right there, Bob. Prices have gone up by 57% in 10 years, but wages have gone up 31%.
Yes, and there will be pressure from staff and employees to have their wages increased because, as Joe said earlier, the cost of living is beginning to hurt. Not just at the lower level, but even at the upper levels. People cannot afford to, pay the bills. They're hurting. And as you may have seen or heard, there's a petition going around saying, don't pay your bills. So if you've got a mortgage and you have any aspiration of getting one, don't join that petition, and definitely don't stop paying your bills, because that will affect your credit file. So, but what the banks are now doing is they're relying on the statistics from the Office of National Statistics, which are updated every April. And because of the cost of living has risen so much, banks are now factoring in a far higher cost of living element to the calculation now, which means borrowing will become a little bit harder for the first-time buyers, unfortunately. And not least because of the increase in rates as well. So it's not a good time for first time buyers, not a good time at all. I think they really need to be careful and think twice about what and where they buy. Um, there's a lot of landlords coming out the market. Interestingly enough, I heard the other day, the capital gains receipts by the government are at record levels. So landlords are leaving the market. Hopefully, making space for the first-time buyers to come into the market.
A lot of first-time buyers, Bob, are saving regularly and have been for many years to get on that ladder, and it always seems to be the carrot moving further and further away from you. But would you advise, if they're not specifically looking to move right now because of a need, in other words, they're just keeping to save, would you suggest that they sweat this out for maybe 18 months, 2 years, and then just keep the saving going on? Or would you recommend that if you think it's right for you, you should go for it?
The savings won't grow at the same pace as house prices, and as we've seen, current right, inflation on housing is about 11%. And your returns on savings are practically zero. And even if you're investing that money in the stock market, the stock markets have had a bashing last week. So the fund managers are all in turmoil because of the huge losses they've seen. Um, I think if you have to buy, if you're not looking to buy, should you buy now? I think yes, sooner the better, because price, you know, even if prices rise, say 5%, you're not going to catch up because your wages aren't going to increase. So I think whilst you can, do it.
Good advice from Bob there. It's interesting actually because a 2-year fix is just over 3% compared to just under 6% 10 years ago. And demand for first-time properties is up 35% on 2019. So the market is still very strong despite all of this inflationary pressure.
Yeah, and the 40% of net income is quite a good indicator of where there's elasticity in the marketplace, because it can go to 50% and people could probably still survive. It won't be a happy existence because you'll be living just for the mortgage and your bills and your food bills, but you can still afford to pay the mortgage. And I think long-term mortgages will come into play now for first-time buyers. I think we should really be looking at 5 and 10 year products for these guys, given that they're much lower cost. And as long as the product is portable, there's no harm in taking a 7 or 10 year product, as long as you can take it with you to the next house. But it's brokers, unfortunately, think of themselves. They prefer 2 year products, so the client comes back to them in 2 years, so they're able to charge another fee and get another introduction fee from the lender again. So, I think we've got to move away from that. And if you've been reading the press, as I'm sure you guys have, the consumer duty rules come in 12 months. And they are going to be far-reaching across all the financial sector, and it will force people in our business and other businesses to really put the client at the center of everything and make sure they're well looked after, the advice is spot on, they're not being treated unfairly, charges, service levels, it all comes into it. So the huge changes are going to happen in our industry over the next 12, 18 months.
It's frightening to think, actually, and I think your point, Bob, about good financial planning and getting a plan in place, because just since the start of the year, mortgage payments have increased by 20% in just that 6-month period, which is quite something, isn't it, Joe? And when you hear a stat like that, you think, wow.
Yes, I mean, when when any stats are thrown at you, Paul, and you look at it in a percentage basis, it's definitely puts some brakes on your whole process of thought, and you think, oh, hang on a minute, that's there, and I think that as a layman, most people would go past, and it's ridiculous to think, but even even my kids sometimes are now sitting in the passenger seat and going, Dad, have you seen that one was 1.87 a litre, and the one down the road was such and such, and so the numbers do start to get into people's mindset and think, well, that is now getting expensive, and just as the rates are. But I concur with Bob in terms of where the opportunity exists to buy, you've got to buy. And I've said that throughout my property journey life, because if I'd got a penny for every person who told me that house prices were going to tumble and they were sitting there waiting to catch the fall of this fantastic opportunity, they're still standing there waiting for that 30, 40 years later, because it's only gone one way. It has a little neutral stop here and there, and this is probably a neutral stop, and then it'll have a drive. But very rarely has it had a massive reverse. We've not done a corner and a spin around and then gone backwards at all. It's just been a little bit of a reverse where people have said, okay, house prices need to be corrected. And I think so. Every stat that comes out now is actually probably more makes more people aware of where they are, which with the media and our smartphones, it's right in your face all the time. Whereas when we're going back, some years, these things kind of came on the telly and they had a glimpse of it, and then it just kind of didn't matter anymore. But now it's literally in your face all the time. So people are more and more aware of what those percentages mean. So 20%, increase is a huge number, just as a 5.05% increase in the rate has become a huge number. Whereas I can, say that, I'm sure Bob will agree, there have been numbers way higher than that in history when people have just kind of said, oh well, it's gone up and that's the end of that. But now people are, they are working almost to the bone, penny for penny, pound for pound, as to what that income is going to do and what's that going to cost each month for them, and how much money it's going to leave in their pocket. But the facts are the facts, and the facts are that if you continue to save at the rate of the savings that you're going to get, you may as well find a way to buy, and know that there's chances are the capital growth in your property at least will give you some comfort later years, be it 10 years, and you might find it's grown by 10%. It's still 10% more than what your bank and savings are going to be grown by.
Indeed. Last story this week, and talking point really, is the Bank of Mum and Dad, or BOMAD as it's now called. They're suggesting that gifts and loans will total 25 billion over the next 3 years, up until this year, next year, and 2024. Supporting almost half of first-time buyers' transactions, according to property group Savills. In the 3 years to 2024, nearly 500,000 first-time buyers, or almost 1 in 2 first-time buyers, will get financial help from a parent or other family member, says the company, as rising house prices put pressure on savings for a deposit. Is this something that the financial services industry is beginning to recognise? There's 500,000 people there using other people's money to buy property. Bob, is that something that is acknowledged in the mortgage market?
It is, yeah. It's perfectly acceptable to take money from parents as a gift, or relatives, even friends. Where the banks are clamping up a bit is money from overseas. Some banks are not accepting any funds outside the EEC, and those that do really want the root source of those funds before they'll take that as a gifted deposit, for example. But yeah, it's always been there. The lenders do want to know that the person giving the gift doesn't have any interest in the house, or begins to live there. That gets a bit complicated, so they have to sign a little declaration to that effect. And the parents can choose, in some cases, to even take a second charge on the property for the money they're giving you, just in case, for example, a newlywed couple, parents are helping, to the tune of say 50,000. In the event of a separation, that money is not returnable to the parents, so it goes 50-50 towards the couple. But if there was a charge on the property, then their parents' deposit is, protected. So a lot of parents are beginning to do that, given the high failure of marriages these days.
Indeed.
But yeah, no, it's perfectly acceptable. The gifts can be unlimited, but some banks do say, look, you guys are buying the property, you too must put some money in, otherwise, you're not really showing us that you're good, sensible savers and financial planners by not having any penny saved up for yourself. But yeah, it happens a lot. 25 billion, I think, is the forecast over the next 3 years, and that will only set to continue because prices aren't going down by the looks of it. So first-time buyers are going to need a lot more help from parents, and parents can use this as a tax saving opportunity as well, because if they're of significant wealth, giving money away is a good thing, because that they themselves can lower their inheritance tax bill down the line. So it's all about planning. It's all about understanding what you're doing, the effects of giving money away and taking it, and how to protect that money, which is more important as well.
It's interesting the effect that the pandemic had on the Bank of Mum and Dad in 2021. On the screen at the moment, we've got the number of assisted loans from 2006 up to the projected figure of 2024. And in 2006, 131,000 loans were assisted, fell down to 91,000 in 2008. But 2020, it was 131,000 again. But then 2021, 198,000. And the value of the assistance was 10,700. So it's almost half of mortgages in that year. 49% were assisted. And the suggestion was at that time, Bob, that it was the fact that the lenders, because obviously had the stamp duty incentive as well, but the lenders were providing better deals for higher deposits.
Yes, the stamp duty was a big impetus for the market back then. But yeah, banks have always wanting to lend money, otherwise they don't make money. So they're always innovating new schemes, and particularly for the guarantor market for parents, you no longer have to put a cash deposit in. Some banks allow parents to give a charge on their property. So there's a myriad of schemes available for the first-time buyer. You just need to understand what they are and which ones will help you, firstly, secure the most money and at the best rate. So as long as you're talking to somebody competent, all the schemes in the marketplace should be put before you, and all the safeguards for the parents as well, because it's not just about you borrowing it. You have to look at the parents as well and make sure their money's not wasted.
Okay, Joe, put you on the spot for a second. Bit of advice for anyone looking to get into the property market at this volatile time. What would your advice be? What one pot of wisdom would you give them?
Buy.
Ever the salesman, eh, Joe?
No, it's not. It's not about being the salesman, Paul. It's about the knowledge and the history that we've gone through, and in spite of all of the ups and downs that we actually faced during that journey, I've been an advocate of people wanting to get onto the property ladder, and there's a lot of things that you have to sort of take into consideration as far as I'm concerned. There's a hell of a discipline that actually comes into when you are a home owner. And that is a great tool for young first-time buyers, because once they are on that the first run of the ladder and they have that sense of owning something, their whole discipline changes. That carefree attitude of I don't care doesn't sort of happen. And it is a good way, it's a good barometer for their life to start to sort of think, well, I've now got this. And once they've got it, they very rarely want to lose it. And so therefore it actually creates a certain discipline. So, and not having that discipline means that, they'll do what they want to do, which is fine, because Bank of Mum and Dad will always be there to bail them out to a large extent. But even Bank of Mum and Dad would like to see some good happening out of what they've done. And if it means that they are supporting their siblings, their children, in buying something, it does a number of things. So when I say buy, I say that because I think that it does a whole myriad of things for people within the family and in the structure. And it also creates a discipline, but also makes them feel that they are creating their future wealth of some sort, albeit it may be in a capital investment return of that. And people do that. I've been doing valuations for properties for God knows how long now. And people say to me, yeah, but that guy sold it for that price and ours must be worth X. And I just love that sort of challenge, the fight of saying that we must be worth more now because we're doing X, Y, Z. I've just done an extension, it must be worth more, and so forth. And I actually applaud that. I think that's the energy that it brings for home ownership in this country. So whilst it's a good salesman's attitude, it's also a very concerning attitude, Paul.
One thing, Bob, interesting about the Bank of Mum and Dad is that the Help to Buy scheme comes to an end in March of next year, 2023. So that's helped 40,000 loans for first-time buyers, and they've provided 2.9 billion of financial assistance. So that's quite a significant level of support. So I'm guessing that the Bank of Mum and Dad's going to be even more popular post-March of next year.
I think it will be, yeah. Although the scheme is ending in March, the last application is in October. So if you're not on the ladder by then, you won't complete by March. So if you are looking down Help to Buy route, you've really got to move quickly. But yeah, Bank of Mom and Dad, I think it will always have an importance. We're doing a lot of equity release schemes purely for the purpose of giving it to your children, um, which is a great tax saving advice mechanism for the parents, and it helps the kids to get on the ladder. And as Joe said, yeah, I think it's that feeling of being wealthier year on year that drives people to actually, continue the house buying journey. And given rents are now sky high, mortgage payments are going to be a lot less. So that
Mm.
mentality of why am I paying the landlord for his property and his future asset growth? Why am I not buying myself? I think that drives a lot of people. Many people see rental as wasted money, especially in our community. We hate renting. We would rather
Mm.
buy and pay £200 more than the rent, but it's our asset. It will grow in the future. It's something that we can maybe leave to our children down the line, and that's how many people are starting to think. It's a long term, long play, long term game.
So to wrap up then, Bob, it's one thing to own a house, but to pay for it's another thing. So what piece of advice would you give after this week's news?
I think take advice from somebody in the property game like Joe, or if it's finance, give me a call. We'll guide you. We'll let you know what your capacity is, and every lender has a different borrowing level because for the same income, same expenditure, you'll be surprised at the variance of money you can get from the high street and the specialist lenders. So whilst it might appear out of reach, it may not be. So you just need to consult somebody who knows the whole market, who's able to do the calculations for you, and then providing it's all affordable, go for it.
Sound advice as always, gentlemen. Thank you so much. And thank you to you for watching Property Matters this week. We'll be back with another Property Matters at the same time next week.